My name is Lidia Treiber. I am fixed income research, and what I do is I do a lot of analysis and provide a lot of insights for investors on fixed income markets. I started my career in finance while I was at university. And I worked in New York, and I think the whole thing about banking deals and investment markets and what's been happening with the economy, that really excited me. So after I graduated, I took a full-time position in New York City, and that really gave me the opportunity to have a very great and very interesting career in finance so far. And I worked in a portfolio management team where I did a lot of research on investments. And through that, it brought me to London. And I've been here for 10 years. I've now been with WisdomTree for probably 3 years, focused on building the fixed income business here in Europe. So AT1 CoCos, to give you a little bit of background, are generally issued by banks. And what's happened is that since the 2020 liquidity crisis, investors were quite worried about markets, and we saw yields in a lot of fixed income asset classes rise to quite high levels. And for the AT1 CoCo asset class, it reached an all-time high of around 15%. And it was a bit of a disconnect between the fundamentals of these actual banks and what the market was pricing in, more of a fear of a complete collapse of the investment markets. And what we saw is, as soon as the markets realized that the banks were being supported by both the governments and the regulators, we saw very strong demand from investors that are comfortable with the actual fundamentals of the banks, which generally are of investment grade credit rating, but they're getting a bit more yield by investing in lower parts of the bank's capital structure. So they're getting a little bit more yield, and that's really driven, that strong demand for this asset class has driven very strong performance last year, and it continues to drive very strong performance this year. Common equity tier 1 ratios, or CET1 ratios as you call them, have actually improved during 2020. And what we saw was that actually the regulators and the governments provided very strong support. And when we saw the regulators ask the banks to withhold dividend payments and share buybacks, that actually helped maintain and preserve the capital ratios. And even this year, from the most recent financial statements, we've seen that the banks have continued to maintain a buffer between their common equity tier 1 ratio, the CET1 ratio, and the AT1 CoCos trigger ratios. So that really has provided support for investors looking for that extra yield in this asset class, and the comfort that the capital ratios have remained at comfortable levels. Now, to address your second question around, with yields lower today, why are investors still investing? It really comes with how the asset class has behaved as well in this rising yield environment. And what we've seen is that actually it's been very resilient. And it's driven by a couple of things. Firstly, the banking sector benefits from this steepening in the yield curve. And secondly, the actual fundamentals that we've mentioned of the banking sector have remained strong. So investors are attracted to the yield in the asset class, and it's supported by both the fundamentals and how the asset class behaves in the current environment that we are today, which is that rising yield environment. The European Banking Authority released their most recent EU-wide stress test on the 30th of July this year. And what you saw was that the regulators were quite comfortable with the capital ratios that the banks revealed. They remained, even in their most severe stress test, around 10%, which really highlights that the regulation that we've seen in the banking sector since the 2008 financial crisis has really helped boost the balance sheets of the banks. And even in the most recent, quite severe crisis that we saw in 2020, the banks and the AT1 CoCos asset class was showing to be, quite resilient. And I think one interesting aspect as well from the stress test was that when they looked at the start of the stress test, which had end of 2020 data, the banks actually had capital ratios or CET1 ratios at some of the highest levels that they had been since the EBA started conducting these stress tests. So again, very, very reassuring for the European banking sector. A key shift in the European bond market has been the rise of European Union bond issuance. And what we saw was that, this is the first time that we've seen, quite a unified Europe in terms of coming together in times of crisis. And the European Commission essentially put forward 2 new programs last year, and the next generation, which was the second of the 2, got approval this year. And really, that's provided now, as together, both programs, over 850 billion in new issuance of European Union bonds to be issued over the coming years, and really transforming the fixed income landscape as we know it today. So the SURE and Next Generation program, they're quite unique programs in the sense that all European Union bonds issued under the SURE program are social bonds under the ICMA principles. And for the Next Generation program, which is the larger of the 2, we're looking at over 750 billion in new issuance. Around 30% of the bonds are going to be issued towards green goal initiatives, climate change, etc. And so this really has transformed the social and green bond landscape, because alone that 30% of issuance is going to be one of the largest green bond schemes that we've seen launched since the green bond market started. So it's quite an exciting time for investors that are looking to transition their portfolios to become more social or green, or just generally more ESG friendly. And it gives an investor an opportunity to invest in an asset class that is of very high credit quality, but again, are pushing towards very positive and common goals for the common good. The actual Next Generation program, a big bulk of the program is going to be towards a lot of recovery and resilience funding to help transform EU member states into more technologically innovative as well as more climate friendly regions. And what every EU member state has to do to obtain the funds is provide a recovery plan in terms of how they're going to use those funds. And what we've seen from Spain is that they've submitted their plan, and it's received overwhelmingly positive acceptance from the Commission. And around 40% of the funding that the Spain has put forward is going to be towards climate change initiatives. And a lot of those measures really are going to make Spain more economically resilient. It's about making buildings more energy efficient. It's about focusing on the education and economically how to provide more support for the economy today as well as going forward. And this is good news for Spain because it's really about improving the growth potential, the resilience of the economy, job creation, and really the social well-being of Spain. AT1 CoCos have historically shown to actually perform very strongly in periods of rising rates and actually do better than a lot of fixed income asset classes, such as investment grade corporate bonds or government bonds, for example. And that is very attractive because we're faced at the moment with this rising bond yield environment. So the asset class from that perspective is quite attractive for the portfolio. In addition to its performance and how it does, or how it has behaved historically in a rising yield environment, it also provides a very high income. And this is something that investors are struggling with because bond yields have fallen quite considerably over the past few months. And if you're looking opportunistically on a relative value basis, what asset classes offer that enhancement in yield, AT1 CoCos has shown to provide more yield and a lower duration exposure than many other fixed income asset classes such as emerging market debt. So I think EU bonds has really been, quite an attractive and sexy asset class this year because it's new, it's growing, and essentially it's joint debt providing support for all of Europe. And historically, investors would have to buy, if they wanted to buy more of that very safe haven type investments, they would buy their government's debt. And now there's a new tool. They can buy joint debt that supports all of Europe that has that AAA credit rating, and it provides, it has behaved very similarly, looking historically to the German sovereign bonds. So it's really an area where investors can allocate to a safe haven asset, and because actually it has a bit more duration, what we've seen is when you have equities in your portfolio, having very high credit quality type bond with long duration has actually provided a bit of an uplift and risk reduction when you see your equity part of your portfolio correct. So it's quite an interesting asset class to include in a multi-asset portfolio where you do have equity, and we could run into the end of the year having a run-up in COVID cases, and unfortunately having a bit of a correction in equity markets towards the end of the year. So we launched recently the first ETF to gain access to the European Union bond market, and the way that we've constructed it is that it only gains exposure to the European Union bonds from the Shore and Next Generation program, which we talked about. So it's really been built in a way to be very ESG friendly, providing investors a way to gain access to the European Union bond asset class, but also have a great exposure to social and green bonds.